It is April. You are staring at your tax return. You made decent money last year, invested some of it, felt smart about it, and now the IRS is asking you to hand over a chunk of the gains you thought you had locked in. You pay it, because that is what you do. What you do not know is that somewhere, right there, inside the app you used to make those trades, there was a mechanism, a quiet, automated, entirely legal mechanism that could have reduced that bill, maybe significantly, and you never turned it on. That is not a dramatic hypothetical. That is what happens to a meaningful percentage of Robinhood users every single year. They invest, they grow their portfolio, they sell at the right time, and then they hand over more to the government than they legally had to because they did not understand something called tax loss harvesting. This video is about that feature, what it actually does, how the math works, where the line is between smart strategy and dangerous oversimplification, and why the most interesting question is not whether you should use it, but whether Robinhood, the company that gave you free trades and a confetti animation when you bought your first stock, is really the right place to trust with something this precise. Let us start from the beginning. The setup. Why taxes on investments are weird. Most people understand taxes on income pretty intuitively. You earn money, the government takes a percentage, you get a paycheck. Simple. Annoying, but simple. Investment taxes are different, and the difference is the thing that makes tax loss harvesting possible. When you buy a stock, nothing taxable happens. You just own it. The value can go up, it can go down, and none of that matters to the IRS until you sell. The moment you sell, the government wants to know two things. How much did you pay for it, and how much did you get for it? The difference is your capital gain, and that gain is what gets taxed. Now, here's where it gets interesting. The tax rate on that gain depends on how long you held the asset. If you held it for less than a year, it gets taxed as ordinary income, the same rate as your salary. If you held it for more than a year, you get the long-term capital gains rate, which is lower. Depending on your income bracket, that rate is either 0, 15, or 20%. So time actually matters, not just for compound growth, which everyone talks about, but for what percentage of your growth the government claims. Now, here's the part that most retail investors miss entirely. The IRS doesn't just look at your winners, it looks at your entire portfolio's net position. If you have gains in some assets and losses in others, those losses can cancel out those gains, dollar for dollar, before the tax calculation even happens. That's the engine underneath tax loss harvesting. It's not a loophole, it's not a trick, it's just the basic arithmetic of how investment taxes are calculated, deployed deliberately and strategically. But making it work well requires precision, and that's where things get complicated. What tax loss harvesting actually is. Let's walk through a simple example. Say you invested $10,000 at the start of the year. You put $5,000 into company A, call it a tech stock, and $5,000 into company B, a retail company. By November, company A is up 40%. Your position is now worth $7,000. Company B, meanwhile, has been crushed. Supply chain issues, a bad earnings call, whatever. It's now worth $3,000. You're sitting on a $2,000 loss there. If you sell Company A right now, you have a $2,000 capital gain. At a 15% long-term rate, that's $300 owed to the IRS. But what if, before you file, you also sold Company B? You realize that $2,000 loss. Now your net capital gain is zero. $2,000 up, $2,000 down. The IRS gets nothing. That's tax loss harvesting in its most naked form. You deliberately sell the losing position to offset the winning one. Now you're probably thinking, but now I'm out of Company B. I sold the stock I might have wanted to keep. And this is where the strategy gets a little more sophisticated and where Robinhood's version of it enters the picture. The general approach is this. After you sell the loser, you reinvest that money into something similar. Not the same stock, we'll get to why in a moment, but something that tracks the same sector or the same index or moves in a similar direction. That way you maintain your market exposure. You don't miss the recovery if and when it happens. You just harvested the loss on paper, reset your cost basis, and kept your portfolio essentially intact. When it works well, it's elegant. You're not avoiding taxes forever, you're deferring them. That deferred tax is money that stays in your portfolio, compounding for years longer than it otherwise would have. The time value of that money is real. Across decades and multiple market cycles, it adds up to something meaningful. The question is, can a commission-free retail trading app actually execute this well? How Robinhood Gold's tax-loss harvesting works. Robinhood launched its tax-loss harvesting feature as part of Robinhood Gold, its subscription tier, which as of recent years runs around $5 a month. The feature is called automatic tax-loss harvesting, and the key word there is automatic. Here's how it works within the platform. When you invest through Robinhood's IRA product, specifically the Robinhood IRA with the tax-loss harvesting feature enabled, the system monitors your portfolio continuously. It's looking for positions that are sitting at a loss relative to what you paid for them. When a position falls far enough below its cost basis to make harvesting worthwhile, accounting for transaction costs, which on Robinhood are zero, and the potential benefit, it will sell that position. Then it reinvests the proceeds into a similar but not identical security. The idea is to maintain your exposure to the market or the sector while locking in the tax loss on paper. This all happens without you doing anything. You set it up, you enable the feature, and the algorithm handles the rest. For someone who doesn't want to actively manage their taxes, who doesn't want to sit down in November and manually audit which positions are underwater, this sounds genuinely useful. And in the narrow context of what it promises to do, it mostly works as described. But there are several things the marketing doesn't fully explain, and those things matter. The wash sale rule, the invisible wall. Here is the uncomfortable part. There's a tax rule called the wash sale rule. It's been around since 1954, and it is specifically designed to stop you from doing exactly what tax loss harvesting is trying to do, at least if you do it sloppily. The rule says this: if you sell a security at a loss, and within 30 days before or after that sale you buy a substantially identical security, the IRS will disallow the loss. You cannot claim it. The harvested loss disappears. The whole exercise becomes pointless. So if you sell your shares of, say, an S&P 500 index fund from Vanguard because it is down, and then immediately buy the S&P 500 index fund from Fidelity, the IRS considers those substantially identical. You sold and bought the same thing. Wash sale. Loss disallowed. This is why the substitute security matters so much. When Robinhood sells your losing position and buys something similar, it has to be different enough to survive a wash sale challenge, but similar enough that you actually maintain your intended market exposure. For broad index funds, there are reasonable substitutes. You can swap between funds tracking slightly different indexes, the S&P 500 versus the total market, for instance, and make a credible argument that they are not substantially identical. But here's the thing nobody talks about enough. The IRS has never precisely defined what substantially identical means for funds. The guidance is genuinely murky. What we have is a collection of cautious interpretations from tax attorneys, some rulings from the 1940s about bonds, and a lot of practitioners making educated guesses. Robinhood is not a tax attorney, it's an app, and the substitutions it makes are built on reasonable assumptions, but they are still assumptions. If the IRS ever decides to clarify the rule in a stricter direction, or if your specific situation creates a wash sale trigger that the algorithm did not anticipate, you may end up having claimed a deduction that gets unwound in an audit. The risk is probably low, but it's not zero. And when you're relying on an automated system to make those calls for you, you may not even know what substitutions were made until you look at a transaction history most users never read.